Hey everybody, just logging on here to do a live stream to just show off a new tool that we made here. We launched it yesterday in the Moontower app. It's called Hedge Analysis, and it basically the idea of it is you could think of it as a pairs idea where let's say you are long. We're going to use Tesla for example. Let's say you're long Tesla and you wanted to hedge it with short QQQ, and just to get an idea of like what the risk of that relationship looks like. So it's basically this concept of beta hedging. I'll talk about the application of it a little bit later too. But I just want to show you how the tool works, and and along the way we'll learn some useful things, and we're going to learn about what beta is, what correlation is, what idiosyncratic risk is. We'll learn about what the formulas are as well. So just give me 1 second here, and we'll get started. Okay, this is what the tool looks like. Okay, so like I said, let's start with Tesla here. We're gonna put in Tesla. So first, actually, let me first show you what this looks like right now. Let me expand this. Make this a little bigger. You can kind of see we're starting to. I mean, not starting to, but we've been adding a lot of tools lately this year in the app. So we've now broken this apart where we have the starter tools here for people that are on a starter plan, and then we have the pro tools are more in depth options related analytics. So we kind of break those up as top of funnel and the drill down. But this is all the pro stuff here, and then up here we've got the selection of tools here for people on the starter plan. So the hedge ratio tool, which got the little beta sign here for the icon. That's part of the starter plan. Okay, so the easiest way to do this is by demonstration. So we're going to put Tesla in here as the reference asset. Let's say we're long 1,000 shares of Tesla, and you want to hedge it by being short the Qs. I'm not saying you should do this. I'm just saying what if. Okay. Let me run calculate hedge analysis. Okay. So let me erase this up here. All right. So what are we looking at here? So this is looking at a look back of 365 days. So your N here is going to be somewhere around 251 days because this is looking back 365 calendar days. So you have about 250 samples in this period. Okay, and we go down here and we have. I'm going to talk about the summary page, the summary line up here, and how to interpret it. But first, we'll go down here and just show. This is your daily returns for QQQ versus Tesla. So Tesla daily returns are on your x-axis, and QQQ daily returns are on your y-axis. So that's the scatter plot there. You have a best fit line here of, well, most importantly, the slope here is 0.235 or 0.24. You'll notice that the slope of that best fit line is the same as your beta. We're going to get into that. So that's just your daily return scatter plot. This is your rolling 21-day correlation. That's the purple line is your rolling 21-day correlation. And then your idiosyncratic risk is the orange line. I'll explain that. Some people call that risk remaining. Some people call that unexplained risk. The last few years I hear this called idio for idiosyncratic. So I'll just use idio, but I'll get into that as well. But you can see on this chart here, you can look at your correlation. You can say, hey, well, let me look at it. The rolling 42-day correlation. Obviously, the correlation is going to look less volatile as you smooth it over a longer number of days. So we default it to 21. And you can kind of see that the correlation has quite a big range. That rolling 21-day correlation between Tesla and the Qs is as low as 17% correlated on December 4th. And, a high number here would be like basically 95% correlated. And you notice here, this high period of correlation, they always say like in a crisis, all correlations go to 1. Well, you can see all that market stress in April, and that's when you get the high correlation. So QQQ and Tesla are highly correlated. This is pretty normal pattern when the markets are stressed, correlations increase, and here it's plain as day here in the picture. Okay. And then we have our beta. Your beta is related to correlation. So the beta of the QQQ to Tesla is, the last reading of it is only 10 beta. So it's pretty loosely related. It's related. Beta is related to correlation, but it's really correlation times the volatility ratio of the two assets. And we'll kind of go into that formula a little bit, or that discussion a little bit. But so this is like your rolling beta over time. Your beta answers the question if this is saying if my reference asset, in this case Tesla, is up 1%, how much do I expect the QQQ to be up? And if the beta is 0.1, then you expect the QQQ to be up only 10 basis points, right? Normally, we're used to looking at this as where the reference asset is the SPX, and you would say you're looking at Microsoft, and maybe Microsoft's beta is 1.1. So if the SPX is up 1%, you'd expect Microsoft to be up 1.1%. The risk remaining is kind of the idea of like how sort of big the error bar is around that. But beta takes this correlation on its own is not very helpful, right? Because I say, if the correlation is 0.9, what that means is if my reference asset is up 1 standard deviation, I expect the hedge asset to be up 0.9 of its own standard deviation, which is this is not a very useful or intuitive way of looking at things. Beta is the thing that turns it from saying, hey, for 1 standard deviation move, instead of being in standard deviations of each asset, we're just looking at, we can convert everything to percent terms. So that's because we just scale the correlation. We multiply it by the volatility ratio, and that's how you end up with a beta. That's all that is. Okay, so let's go back up to the top here. Let's kind of talk about what is this relationship, QQQ versus Tesla. So over the entire sample period, the correlation is 0.69. And what that correlation is it's a simple, you could compute that in Excel, like just say use the correlation function, and this is using daily returns. So this is the correlation of daily returns is 0.69. So again, what that means is if Tesla is up 1 standard deviation, QQQ is up 0.69 of its own standard deviation. Okay. Beta takes that correlation and then it scales it by the volatility ratio of the two vols. Now, right. So we know Tesla is more volatile. Tesla is more volatile than the Qs, right? And actually, we can look at the tooltip here. So the daily volatility over this entire sample period of Tesla is about 5% a day, and the volatility is 1.7% a day for the Qs. So Tesla is about 3 times as volatile as the Qs are. So if you take that volatility ratio, which is going to be QQQ vol over Tesla vol times the correlation, that's how you end up with a beta. And that beta is 0.234 or 0.235 or 0.24, which you notice is exactly the same as the slope of the regression line. Okay. A quick thing here. If I'm long 1,000 shares of Tesla, and if Tesla and the Qs have the same, they're 100% correlated, then I would need to be short 1,000. And if they were the same price, I'd be short 1,000 shares of Qs to hedge it. Okay. But the Qs, in this case, the beta is only 0.24. So you would think that if I'm long 1,000 shares of Tesla, I need to be short almost 4 times, right, as much Qs to be hedged, right? Because the Qs only have a 0.2, call it a 25% beta, right? So I would need to have 4 times as much Qs to hedge. So I would think I would need to be short 4,000 shares. But that's not actually your hedge ratio, because remember that Qs are more expensive than Tesla, right? So the Qs are actually, if we go to hedge ratio, so the Tesla is $319, the Qs are $533, right? So what we have to do is we take the beta and we have to multiply that by the hedge ratio, and that's how you end up. The beta times the hedge ratio is how you end up. The beta times the price ratio. Apologize. Beta times the price ratio is how you end up with a hedge ratio. So that's where we get this 2,541 shares to sell. So to be hedged, if I'm long 1,000 shares of Tesla, I need to short about 2,500 shares of Qs to be hedged, right? So instead of having to sell 4,000 shares, which would be the case if I was just using the beta, I have to take into account the fact that, well, the Qs are more expensive than Tesla. Okay, so I have to sell 2,500 shares to be hedged. Then we have this thing, this idio volatility remaining. Okay, now I won't derive the formula here. I've done that on the blog, but the formula is, we do walk through the formula here. And the formula for this is the square root of 1 minus the R squared, or 1 minus the correlation squared. And we get a number like 70, we get a number of 72% based upon a correlation of 0.69. The idio is 72%. What the heck does that mean? Okay. So what that's saying is you've got this spread on, but 72% of the vol of the reference asset is unexplained by the hedge asset, right? So I think I said that backwards, but the point is this: if I'm long, I have this spread on. I'm long 1,000 shares of Tesla, and I'm short 2,500 shares of QQQ. Okay, now on a given day, well, first of all, we kind of saw here, Tesla vol is about 80, right? So it moves 5% according to this. So if the daily vol is 5%, then rule of 16, that's 80 vol for a year, right? So if I'm long 1,000 shares of Tesla, 1,000 shares of Tesla is Tesla's $300 something here. Yeah, like $320. Call it $300. So $300. 80%, you have in your one standard deviation P&L on a $300,000. If you have a $300,000 worth of Tesla, 1,000 shares of a roughly $300 stock, you have $300,000 of Tesla at 80 vol. That's your one standard deviation P&L is to make or lose $240,000 in a year, right? That's your daily vol. That's your annual vol. Your daily vol is a 5% of the $300,000. So that's about $15,000 a day. So you expect your Tesla P&L, if it was unhedged, to have a one standard deviation daily P&L of about $15,000 a day on a $300,000 position. Okay. When you hedge it, the P&L variance will fall, right? That's the reason why you hedge it, so that you have less P&L variation. What this is saying is that even though you're hedged with Qs, because the correlation is only 0.69, and remember the idio is only a function of the correlation here. It's 1 minus the square root of 1 minus correlation squared. Because your correlation is 0.69, which it sounds like a high number, right? But you end up with this much idiosyncratic volatility. So what does that mean? 72% of that $15,000 a day of variation is basically not mitigated, right? It's like it's like, yeah, you think you're cutting your volatility down, but you're still going to have over 10,000, call it like it's about $11,000, about 11,000, between 11 and $12,000 of variation in your Tesla, in your P&L, because you did not actually hedge it all out. Like if you sold something that was 100% correlated to Tesla, then you would have no idiosyncratic volatility remaining, right? Like you wouldn't, it's like you would be flat. Your P&L wouldn't vary on the $300,000 Tesla position. You'd be basically flat. But because you're short this thing that's only 69.69 correlated, you've only actually cut your you've only really hedged like less than 30% of your risk. So you're still left swinging $11,000 or $12,000 a day. I mean, it's not $15,000 a day, but it's still $11,000 or $12,000 a day. So it's not a very good hedge, which is, first of all, that's like completely intuitive. Like you wouldn't buy Tesla and short the Qs and think that you were hedged in any way, right? But the math sort of bears that out as well. So you've only hedged like $3,000 or $4,000 a day of systematic risk by shorting the Qs against your long Tesla position. So that's basically explains how idiosyncratic risk works, risk remaining. I'll just say something real quick about the use of this regarding, like, for example, as a market maker. So when you're a market maker in options, your job isn't really to take on, like, you don't want to take the delta risk on, but it's part of the job, right? You're streaming quotes, you get lifted on some live calls, you're going to be short deltas in that name. But the other thing that market makers do is they don't want to be hedging every single thing all the time, right? Because every time you hedge, there's a cost involved. You have to cross the bid-ask spread, or even if you have to sit on the bid, there's presumably still a cost there when you get hit because of adverse selection. So, you don't have any edge. The market maker doesn't have any edge in the underlier. So they understand that every time I trade the underlying, I'm losing just a little bit, right? So they don't want to hedge that often, but they have to hedge because, that's how you stay in business. So you want to reduce your P&L variation due to things that you're not taking, you're not getting paid for, right? Like their whole idea is that they make alpha on identifying cheap or expensive volatility, not on the delta risk. So what they do is all day long, they're streaming all these quotes. They're getting hit and lifted on all these live options. So you could just imagine that they're filling up buckets of deltas. They're just picking up like, okay, I'm long. I've picked up 50,000 Tesla deltas. I'm getting short 80,000 Microsoft deltas. I'm long 15,000 IBIT deltas, whatever it is. Like all these deltas are coming back to them. And what they're going to do is they can basically, by using tools like this, they can turn all their deltas into some kind of benchmark delta. So they could say, you know what, I'm just going to take all my tech names and I'm just going to convert them into QQQ delta doing this, basically figuring out what's the equivalent amount of shares. And they're going to be long deltas in some names and short deltas in other names. And they're just going to agglomerate it all and compute a net Q's delta that they're long or short that they need to hedge. And then it's easy because then you can just trade the futures, right? Or like most commonly people like to use ES. I've seen groups, they organize their deltas by some kind of benchmark. So they have some names that they hedge with SPX, some hedge names that they're going to hedge with Russell futures, and some names they're going to hedge with NASDAQ futures. But they'll just basically group them into families like that and then use the appropriate benchmark future to hedge the residual delta that they're getting. So what that allows them to do is not have to hedge the deltas at point of sale in the name. So like if I get lifted on a bunch of Tesla delta, I don't need to go out and like go race with everybody else to necessarily buy the Tesla delta. I could just accept that I'm short this Tesla delta. I can take those deltas, group them all together with other deltas, hedge in the futures, and then I can work out of the Tesla deltas at my own leisure. Or they'll probably have some program that says, work out of all of my random stock deltas that I've accumulated, work out of them at 1% an hour. Just work out of the, don't be more than 1% of the volume in these names over the course of the day. And you're going to work out of those deltas really slowly. And then as your deltas kind of come off, you can cover the appropriate amount of futures. And you kind of have this, it's more of a continuous process going on all day long where they're working out of stock deltas. But the thing is at the point of sale, if they take on a bunch of short deltas all at once in the market, they can go ahead and just buy futures and cover their systematic risk. Like maybe they got lifted across on calls on everything as the market kind of like swept all deltas higher. You can just go buy the futures, and at least you're covered on your systematic risk. And then the desk will know, they kind of have a sense now. Well, I know how much idiosyncratic risk I have in my book because I'm short all these different stock deltas, but I'm long the futures, and I know how much error there is in that hedge. And then what they can do is say, I'm going to work out of these names, and I'm going to work out of them at a pace that balances how much idiosyncratic risk I'm willing to have versus the slippage that would occur if I tried to get out of my to hedge out of my risk faster than, say, being 1% of the volume. If their idiosyncratic risk is too large or they're really uncomfortable with their risk remaining, they can, you can always just try to be a larger part of the volume and cover exactly the deltas that you have. You're like, what? I want to buy all these Tesla deltas back. I'm going to cover them. This is all, by the way, this is kind of like more professional stuff where it's how professionals are really thinking. But the way they often think about a hedge at the point of sale is if you don't think you're being adversely selected against on delta, then your deltas are random. So that's why you can work out of them at your own leisure. Like there's no reason to think that the person who bought the Tesla calls from you is smart about the direction of Tesla, right? So those are random deltas. If you traded with a counterparty that you thought was informed on delta, well, then you would go hedge at point of sale immediately, and you would not go through this process of I'm going to just hedge with the index futures. That you would try to actually not only hedge the stock that you got short, but possibly even overhedge and bet with the call buyer who basically gave you information. They're probably going to beat you on the calls, but they gave you some information. So in any case, that's how that's kind of how this idea of idiosyncratic risk is used in the context of market making. And then, and I'll just we can put up some other names here just to see what happens to this risk remaining when the correlation goes up. Because this is a nonlinear relationship because it's a square root of 1 minus r squared. So what's interesting is risk remaining, I want to say at a correlation of about 84.84, 0.85. Once you're below a correlation of about 0.85, the risk remaining goes beyond 50%. When your correlation is 0.85 or higher, your risk remaining will be less than 50%. You'll have less than 50% of idiosyncratic risk left on it. So let's actually look at something like we can do SPY versus the Qs. There you go, right? SPY versus Q. These are 97 core. You can see right here, there's 97% correlation. You still have idiosyncratic risk. So we know that SPY, just off the top of our heads, right? SPY probably moves about 1% a day. You can look at the beta here. Actually, this is saying 1.4% a day, averaging over the last year, and it has been a more volatile year, right? So that 1.4% a day translates to a slightly higher than 20 vol name. So if you have 1,000 shares of SPY, SPY's about $600, so $600,000. So your daily standard deviation in SPY is about $10,000. If you hedged with Qs, you would mitigate about 75% of the risk. So you would if you were long $600,000 worth of SPY, short $600,000 worth of Qs, you would, or actually you need to use this hedge ratio, right? So you need to sell 968 shares of QQQ, and QQQ is $533. So you would be long $600,000 of SPY and short about $520,000 worth of Qs. And if you had that position on, then your daily P&L would only, instead of varying by $10,000 a day in SPY, right, 1.4% of 600,000, instead of varying by $10,000 a day, it would only be varying by about $2,500 a day, because you'd only have about 26% of that risk remaining. So you would have hedged 75%, 74%, right, of the risk by hedging with Qs, with $530,000 worth of Qs. And here we can see here the correlation, and we can kind of see the correlation here never really, the lowest it's ever dropped in this 1 year sample on a 20 with a 20 back to 21 day look back, it never dropped below 75 core, right? And it's up near 97 at the peak here, and the risk remaining is just sort of the mirror image of that in some way, right? It's just a formula. So here we see when let's find a spot where it's like 85% core. There you go, like 85% core right here, November 28th. Okay, we look at, and we go down here, November 28th, you see there, the risk remaining is about 52%. So that's about right. Like about 85% core means there's about 50% of your risk remaining. So when you see these correlation numbers, you should realize that once a correlation drops below 85, like 50% of the risk of your spread of your trade is not mitigated by your hedge. So correlations, when they get low, you're really not that hedged. And you can see here the risk remaining on these spreads. A lot of this period of time here, and again, when correlations rocketed higher in April, your risk remaining on being long short, on long SPY, short Qs was very small, right? Like you only had 10% error in the hedge. They were pretty much offsetting each other, and that's because all the correlations basically tended towards one during that Liberation Day crisis. So anyway, I hope this was helpful. We just launched this tool in here. It's over here again. It's got that B sign, that icon that I had to hunt down for hedge ratio. And I hope this was helpful. Catch you later.